Welcome back to Retire Higher. In the last episode, I talked about how working impacts your Social Security income. Next, we are going to talk about how provisional income will affect taxes on your Social Security benefits. Before we do that, we need to understand what provisional income is. Provisional income is the sum of all your income plus half of your Social Security income. It is important to note that only half of your Social Security income will count in the provisional income calculation, along with wages if you're employed, 401ks and IRA distributions, interest and dividend income, including interest on tax-free municipal bonds, capital gains, pension payments, taxable portion of inheritance, and any other taxable income sources. Some people must pay taxes on their Social Security benefits depending on their provisional income. If you are single and your provisional income is between $25,000 and $34,000, up to 50% of your Social Security benefits can be counted as taxable income. If your provisional income exceeds $34,000, then up to 85% of your benefits can be counted as taxable income. For married filers, the thresholds are $32,000 and $44,000. These thresholds are often referred to as the Social Security torpedo, representing an explosion in your effective tax rate when you go over these thresholds. As an example, when you go over the first threshold, for every dollar extra you have, it causes $1.50 to be taxed. And once you go over the second threshold, for every extra dollar you have, it causes $1.85 to be taxed. So if you are in the 25% tax bracket, you are paying 37.5 cents in tax per dollar above the first threshold, and 46 cents on every dollar above the second threshold. At a 33% tax bracket, it is 49.5% and 61% effective tax. If Social Security was your only income, your benefits probably are not going to be taxable. You also may not need to file a federal income tax return. If you received income from other sources, then you may have to pay taxes on your benefits. It is noteworthy to mention that, unlike the previous table, which often changes, this table has remained the same since 1985. Why do you think that is? Well, remember, when we said things will happen throughout your retirement that will be beyond your control, more than likely one of you is going to pass away before the other. If we refer to this table, what could happen if a married couple required $40,000 to maintain their standard of living and one of them died? Still needing the $40,000 to maintain their surviving spouse's lifestyle, what changes, if any, would take place with their taxes? Not only would they lose one of their Social Security checks and probably wind up having to withdraw more from their IRA, but according to this table, since they now have to file as a single, the tax on their Social Security would increase from 50% to up to 85%. This is what we call a double whammy. Because taxes vary on your earnings and location, you will want to consult with a tax professional or an advisor about your specific situation. Is there any way to reduce or even eliminate taxes on Social Security income? Possibly, if you are able to reduce your provisional income below the thresholds that affect the taxability of your Social Security benefits. This assumes that you have some flexibility in your retirement income and may not need all the income you receive annually. You can postpone receiving your Social Security benefits either by waiting to file or by suspending your claim for later years in which your other incomes are lower. Or you can reduce your other sources of income calculated in the provisional income. These include wages if you are still working, as well as non-wage sources of income that include distributions from your 401k and IRAs, interest and dividend income, capital gains, pension payments, taxable portion of inheritance, and any other taxable source of income. In fact, even interest earned on tax-free municipal bonds is included in your provisional income. If you are able, you might retire from or reduce your hours at work. If your vocation is important to you, but you do not need the income, perhaps there is a volunteer opportunity that will provide you with the same experience. If you are eligible, you might consider offsetting income with a tax-deductible contribution to a qualified retirement account. Reallocating some of your appropriate non-wage income sources to an account that is not included in your provisional income calculations would shelter those assets from inclusion.